Hello everyone, I'm Sidhant. Today the chapter 3 of the accounting and finance for the bankers, the question and answer session. I will discuss the important question. So the first question, the time value of money applied in. As we have discussed the session, I will also discuss whatever I left in the main lecture series of the chapters. So here also I will discuss the things which I left there, which is important, of course. So the question 1, the time value of the money applied in. As we learned that in the capital budgeting, there are 3 ways we have learned. Here today I will discuss the 4th ways also, which is not very important, but as it is mentioned in our course book, so whatever is in our course book could be important, but by seeing the previous year questions, we can inculcate that what kind of questions they are asking, and through this we can begin the preparations. So the question 1 is the time value of the money applied in. As we have learned, the net present value and the internal rate of return and the payback method. We also discussed the tree method, which is nothing but a condition by applying the conditions, which we will take them separate. But if we take time value of money into concern, then there are 4 methods. We have discussed 3 out of the 4. That is, we have discussed NPV, net present value, internal rate of return, and the third one is payback method. Here also the 4th method is accounting rate of return. So the time value is applied in. As we have learned in the last chapter, that in the net present value, whatever we are getting in the first year, second year, third year, we got to find the present value of all these. So we are taking time into concern, and time value means the present value of all the times. That's the basic meaning of the time value of the money. That if we take 10 years back, then what is the value of the money that you had in your hand today? So this is nothing but the time value. So in the net present value, we are taking time value into concern, so the time value of money applied in net present value. Similarly, in the internal rate of return, we are finding with the same formula, but with a different purpose. So here also the time value of the money applied. But in the payback method, what we are doing, we are just calculating the amount we are getting in the first year, second year, or the third year, and we never find the present value of the particular year with respect to the present value. So in the payback method, we simply taking the values, the yearly payment we are getting is taken into concern in the payback methods. But in accounting rate of return method, what we do, we haven't discussed in the lecture in the lecture as well. So here I will discuss what is accounting rate of return, which is nothing but a second question also. That's why I put deliberately, so that it could be known to you. The accounting rate of return simply finds the profit the company earns throughout years. They will not take the time value, they will not calculate the present value, simply whatever the profit they are getting year wise. For example, any company, let's say company A are getting profit 50,000 in first year, then 15,000 in second year, 30,000 in third year. So in the NPV, what we are doing, we are finding the present value, but here we will not find the present value. We will take the raw data, whatever the data is given year wise, we will calculate this. So 50-50, that is 130 is the total profit it is earning after the tax. That's important. So here the profit is this much, and let's the investment done at the first year is 2 lakh of rupees. So 2 lakh of rupees is, we will write the total investment we are getting at the present is the investment we made. So this is the formula of ARR. Important. One question is also there in our course book. If you want, you can see with the ARR. It's you can easily understand from that. Next as I compared in the last chapter as well, the difference between the IRR and net present value comparison. So the comparison is like that: the net present value is better than the IRR. Reason being, it gives the scale of the businesses what we are doing. Let's say in IRR, if we take internal rate of return, it doesn't specify about the time, about the how much time the project are for, and it will not specify the risk associated with the project. And the third is the scale, how much amount are involved as an investment or the cash flows. Doesn't IRR doesn't specify that, but in the net present value we are getting some values, so that we can easily trace out, we can easily comment upon that whether the projects are chosen or not. If we take example in IRR, let's say the IRR given is 8%, and they in the questions they ask that the current rate of return is 10%. So will you invest in this bond or not? Then the answer is no. Whenever the IRR is less than the rate of return, we will not invest in that project. But if the IRR is 8% and the rate of return is, let's say, 6%, then we will invest in that. So this is the application of IRR. And in the net present value, we are getting some positive or negative value. So it specifically determines the amount you are getting as a profit or you are getting as loss. But in IRR, since the percent in the percentage term, so it will not tell you about how much you are getting as a profit. Whether you are getting a profit, you can find through this, but they will not scale exact values. The problem with the IRR begins when that let's say in project, there are two projects, project A and the project B, and in the project A you are getting only 100 rupees of profit, but in B you are getting 1 lakh of rupees as profit. But if you measure it in the IRR, might be the percentage is less in B, let's say 6%, and here the A the 7%. Okay, so what will you choose? We cannot comment upon if because the percentage terms we cannot scale down the exact values. That's why the IRR filled in that. So we will deal the numericals for this chapter. So the first question is the discount factor at 10% per annum is 0.909 first year, 0.826, 0.751 third year. Calculate the present value if yearly return is 10,000. See, in this question the discounted value is given. You should not confused what discounted factor is. I already told you discounted factor is nothing but a 1 plus the rate and n, the year on which you are calculating the present value, is the discounting factor. Why the name discounting? Because as you are dividing something with some value, so it will be less than the numerator value, so the overall it's discounting. That's why the name is discounting factor. We will solve it through the approach we learned, and we will tell you that what kind of easy question they asked. We have practiced not like this, but we have practiced in a better level, and these are very easy. First we will tell how you will apply whatever I learned, I taught you in the last. Since it is asking present value of all the cash flows, so yearly they are getting 10,000 of rupees. First year, second year, third year, they are getting 10,000, 10,000. So, and here you have made some amount of investment. They haven't specified the investment value. So if you calculate the present value of this, what you will write? You will write 10,000 plus divided by 1 plus rate of return is 10% to the power 1. And for this similarly you will write 1 plus 10 power 2 Similarly for this you will write for the power 3. So if you start calculating it, calculate this, you will get these values as a residuant. So the 10,000 multiplied by 0.909. How you are getting this 0.909? This is nothing but a 1 divided by 1 plus 10 by 100 to the power 1. So this is this 0.909 is nothing but this value. Again this is 0.826, nothing but a 1 by 1 plus 10 by 100 to the power 2. So what we are doing? We are just calculating the values, and you will just observe that they have already given you these values. So you don't need to calculate anything. If you this 0.909 is nothing but the value of 1 by 1 plus 10 by 100 to the power 1. Again this 0.826 which is given for the second year is nothing but 1 by 1 plus 10 by 100 to the power 2, and so on. So in the questions itself they have mentioned everything, so no need to calculate, just need to multiply and move on. So you will find this question's answers, whatever it is. So the next question, in the above question, if the initial investment made is rupees 25,000, state whether investment should be done or not. So here the investment specified that 25,000 is invested. So if you calculate the present value of all this, then how much you will get? Let's calculate 9090. We will not calculate the exact value, we will calculate the approximate value. 8260 plus 7510. So if you calculate this, 0 7 16 1 6 8 7 15 24. So here you are getting 24,860, but you have invested 25,000. So the net present value will be in negative. So you will reject this project. So this is the crux of this question. Next questions we will discuss. Next question, that two projects value is given. You have to specify which project you will choose. So in these questions, since these questions can be framed in multiple ways. For example, the project A and B is given, the rate is same for both, calculate which project to be chosen. Another question like that, these two project cash flows or the projects is given, the rate of returns is different for project A and different for project B. So you need to find the net present value of both, and those which have positive net value will be chosen, and those who have maximum net present value will be chosen. We will solve one questions. Let's say in the project A the rate is given at 15%, and the project B the rate is given at 20%. So we will now compare that which project we will going to choose. So for the project A, we will calculate the net present value. How the net present value calculated? So investment 9,000, which is an outflow of your money, and you are getting these amounts in the future years. So 3,000 divided by 1 plus, what is the R? The R is given 15 by 100 to the power 1. Again in the second year you are getting 3,000 again at the rate of 15 to the power 2, because it's for 2 years. Again for every cash flows you have to write like this, 1500 to the power 3, and so on. And for the project B, similarly you have to write like this, that 9,000 is the initial investment, and the first cash flow is 5,000. 1 plus, here the rate is 20%. The project B, in the project B, you are getting 20% as the overall interest in the project. So you will write 20%, and it's for 1 year since you are getting first year. So for the first year you are getting this much amount, or the present value you are finding for the first year. So you have to write only 1. Again 4000, 1 plus 20 by 100 to the power 2, again, and so on. Here in the questions I haven't mentioned the discounting factor. In the questions you might be given the discounting factor at the rate of 15% for the first interest, second, third, fourth, fifth. They will mention, and if they mention, you don't need to do anything. You just multiply that discounting factor with the amount what we had done in the last example. Here in the last examples we have been provided the discounting factors all along with the questions. So we don't need to do anything. We just have to multiply 10,000 of rupees with the particular discounting, 10,000 rupees with the particular discounting factor of the particular year, and calculate the total amount. You will get the answer. Here we so after calculation, what you find that the amount is 9,798. How? Just you have to find the present value of all these values, and since we have to subtract, this is the 9,798 is the whole amount, this much, and if you subtract 9,000 in it, you will get 798. This is NPV, which is positive, so this is a profitable business. But you have to choose either with the project A or project B, so you will also have to find the present value of this one. So if you calculate the project B present value, you will find that these values are 8,678 minus 9,000, you will get 322, which is in negative. So this should not be chosen. This should be chosen. What if some positive value would come here? If some positive value would have come here, then we have to choose which is the bigger NPV, net present value. So we have to choose that project. We are done with this question. One very important conclusions you can trace out through these examples, that in the project A the rate was 15% and the project B the rate was 20%. So what is the value of IRR? We can find exactly through the scientific calculator, but we can predict that the IRR would be between 15 and 20%, because we have learned that whatever the IRR, if it is greater than the rate of return, then we are in profit. Profit means you can invest in that project, but if IRR is less than some value, the rate of return, then should not be invested. The next question is discount factor at the rate of 15% rate for the first, second, third, fourth is this much. Since in the discount factors are more often than not is given in the question itself, you just need to multiply and move on. And the next at the rate 20% rate for the first year, this much discount rent is given. The initial investment is 9,000 rupees, and the cash flows are 3,000, 3,000, 4,000 and 4,000. Calculate IRR. We have to find the IRR. Then how can IRR can be found? As we have learned that the IRR can be found if the initial investment plus the total amount what we are getting as a present value of the total cash flow, IRR can be calculated when the net present value is 0. So here 0 is the net present. So what we can write, we have to find the value of R. So here in the first initial investment is 9,000, so we can write 9,000 rupees here plus 3,000 the cash flows, it's for the first year, so 1 plus R by 100 to the power 1. Again 3,000, 1 plus R to the power 2. Again 4,000, 1 plus r for power 3, and the last one 4000 1 plus r for power 4. So we can take this negative one here, we will get the positive 9000 is equal to these whole 4 values. Now since r is quite difficult to find in this question because the r to the power 4 is present here, so we can do it with the scientific calculator, but since the scientific calculator is not allowed, so these questions will not be asked by the JAIIB, but there is a simple trick. If the questions could be asked, let's say some examiner is very strict or they can ask these questions as well, then you don't need to do anything, you just see the options, check all the 4 options, put r as the options I had given, and you can calculate which r gives you the amount near to 9000. So you will replace with that r. You can find through the options. Let's say the r is some value, so you will have to write, let's r is 17%, so you have to write here the 17%, 17, 17 and 17, and through the calculator you can find the whatever I told you how to find in the annuity chapter. You can easily find the values and replace it and check whether you are getting 9000. The whatever the r you will get nearby to the 9000 is your answer. You can tick and can move on. So that's it for this chapter, capital budgeting. There is not much hype in this, you just need to have a command in all these concepts. You will easily able to tackle the questions if they asked through this section. Thank you.